So Jerome Powell coming under fire again with from the financial sector to obviously the political sector asking for him to resign. And there is some at least rumblings out there that he might. One of the things that he got under fire lately is he was building a $2.5 billion new Fed headquarters. That's a pretty expensive office building, and they're already $700 million over what the budget was. So you get all these political parties again, a lot of financial people thinking he dropped the ball on raising interest rates when we were at 0%, bringing rates to 0% when we knew all this money was going to be inflationary that the government was printing. And now we have more and more people starting to tell Jerome Powell, maybe his time should be over. Now, it's important to know that the Fed is just not one person, Jerome Powell. I believe there's 19 members, 12 of them vote. And so, again, it's a committee, but, what do you do when a company's having issues? You fire the CEO. And there's a lot of criticism of Jerome Powell and the way he's handled, really from COVID on. And another big person that I follow a lot is Barry Habib. I've shown him here before. But let's hear what he has to say. It's pretty scathing, and somebody I do really like as far as looking at the market and looking forward and knowing where things are headed. What Barry Habib is saying, because he's definitely saying maybe it's time for a change.
We know that in 2021 and 2022, he was really complicit in causing all the inflation. But now he's being criticized for being too restrictive and ignoring many of the signs, Jerome Powell, because you put homebuyers through what you put people through at the grocery store in paying exorbitant prices due to the inflation that he was complicit in is truly a shame. But I want to go through not just criticizing him, but making the case. So if you're all in agreement, which I think you all are, that he ignored the higher numbers that we were getting, you had to be completely blind not to see inflation coming with all of the money that was pumped in. $5 trillion pumped in, not thinking that that could be inflationary. This put the Fed in a position where they kept on pumping money in QE and keeping rates at zero for way too long.
Now, it's important to know in this video, he's mainly talking to people in the mortgage business. That's kind of what Barry Habib specializes in. But in the mortgage business, we really track rates. It's one of the things you do have to know. And everybody agrees, right or wrong, that the Fed made some mistakes, keeping rates too low for too long, and then brought them up so quickly that not only did you get this lock-in effect, you got unnecessary inflation. Look, it was going to be inflationary when we printed all the money in COVID, but the Fed just kind of poured gasoline on that fire. And I do believe you get a Fed that is going to push for lower rates, whether Jerome Powell resigns or not. So we'll see. We're going to keep watching all that data. Another interesting thing is you see at the same time inventory exploding, and two things can be true at one time. Inventory is exploding. There's no doubt about that. And it is worrisome when you look at how fast from where we were just a couple years ago to where we're at now. So we want to look at the trend and where things are going. You see a lot of people making comparisons to 2019. That's kind of the benchmark of where we really lowered rates, right before COVID hit, which is technically January of 2020. March is where a lot of things shut down, but technically the official start date that everybody says is sometime beginning of 2020. And in 2019 was kind of a more normal market. So that's the comparison that everybody likes to do with inventory, as where are we at to those levels. And in this article, they look exactly that. 78 major housing markets where inventory is backed up. And what are they comparing it to? The 2019 pre-pandemic, pre-COVID levels. And they've got this interesting graph here, or I guess chart of all the different markets. And I'm going to go straight to Orlando and look at Orlando, Kissimmee, Sanford area. And we are 45% over pre-pandemic levels. That means we are over what the normal market was before COVID kind of changed real estate as we know it, both in prices and it shot inventory down, all the bidding on homes and everything. And you can see there's a complete list of here properties. Now this is 78, which means there's way more markets that are not even back to 2019 levels, but these are big markets across the United States. And one of the things that I thought was interesting, I want to show this in a different graph, but they show just the difference between 2024 and now. So in a year, inventory has shot up even more. So if you take out this last year, it would be less. But in Orlando, if we compared it to last year, it would have been 8%. You compare it to just 1 year later, 45%, right? That is a big jump up in just 1 year in inventory. And that's where you have people worried about the market and what's going to happen. And so I like to look at history more than anything. So we're going to look at the Orlando area market 20-year history, 2006 to 2025. Kind of crazy that 2006 is about to fall off here as far as the 20-year history put out by the Orlando Regional Realtors Association. And as a benchmark, we're always going to look at 2026 or the aftermath of 2026, the Great Recession. And the highest that I could find in our market was about 26,000 homes on the market at one given time. Currently, we are at 13,957 total homes on the market. That's as the end of May. How far do we have to go back to get to to where we're at? We're already past over pre-pandemic levels, but when did we have this much inventory? And we have to go back to January 2011. So it's all the way back to January of 2011 that we have had over 13,900 homes on the market. So that tells you that that is not normal, right? We are way higher than where we're normally at. But I also like this graph from Redfin that puts things in perspective, because this is sellers. So this is what we're talking about, right? This big jump up in sellers. God, you look even just the last year and a half, that is wild. But where are we at historically? We are not that high historically, right? This goes back to 2013. So our inventory is not a problem. The problem is the buyers, right? The buyers are sitting this out. So the buyers, look at the gulf here between buyers and sellers, right? That is why this is going up, because buyers are not participating in the market. We hit sub 4 million in real estate transactions nationally, which means that buyers are sitting out, right? The payments are too high, prices are too high, at least in their opinion. They're trying to time the market and they're waiting for rates to fall. So many people I talk to get pre-approved and say, we're going to wait till next year. What are they waiting for? They're waiting for lower payments. Also, to put it in perspective, I loaded that chart into ChatGPT, and you can see this is inventory now in Florida, and this is actually Central Florida, that same Orlando metro. I uploaded the spreadsheet or the PDF into ChatGPT, and you can see by this green line that it's all the way back to 2011 since we've had this much inventory, but we've had more inventory many, many times. And then I overlaid rates on top of this. And right, it's no surprise as rates go up, inventory goes up. And there's obviously a relationship there. As payments get more expensive, people don't buy. So really, really interesting to look at, because even though rates are not really changing, the trend or the prediction is for rates to be a lot lower. And what will that do? That will pull more buyers in the market. And that elevator up in inventory is going to level out, which is why you see all the big dogs, the CoreLogics, the Zillow, Fannie Mae, predicting a pretty flat market in appreciation and no major depreciation, because they see this, that it's going to happen. And then just last thing on interest rates, since we are a mortgage channel here and looking at rates, we can see that the 30-year fixed rate ended last week at 6.82%. No surprise, we're drifting back up above that 6.75%, meaning rates are staying higher for longer, which everybody predicted. But I really think we get past this month, next month, see what Jerome Powell does, get a little further into tariffs. What Scott Bessent just put out a pretty good report in tariffs on the income that is brought in, and we shall see. My base case, once rates start falling, they're going to fall, not like a rock like they went up, but they are definitely going to steadily go down. That is going to pull buyers in the market, and it's going to be a really, really different feel this time next year. We'll see how well this ages. This is Rayce Robinson, your favorite Florida mortgage broker. You want information on loan programs, how to use those loan programs, what's a daily success plan like, or you just want to have a conversation about what is the best loan program out there right now. There's a couple that we're doing a lot of. Reach out to me. Have a great day, great week, and I'll talk to you soon.